Everybody. This is Andy Profit. I'm the SIG chair for the AAII PDX Income SIG here in Portland, Oregon. And thank goodness for 2020 is over with. Good grief. I hope the 2021 is better for everybody. Just to mention that we are a SIG that meets here on a monthly basis. And so, I always put this disclaimer up just to make sure everybody is aware. We're just a bunch of guys that get together that want to talk about income investing. And so anything that we say here, you need to take with a grain of salt and check with your investment professionals and your tax advisors. By all means, this is not a group where you can get sound advice by any means. So it's just a bunch of guys sharing information. And, we are self-directed investors, which is in line with what the AAII encourages us to do. And we are learning from each other and hopefully applying some prudent approaches. We're looking for sustainable income and, something that's faster than the rate of inflation and preservation of capital. And, we're looking for long-term buy and hold kind of situations. So, basically, the SIG is primarily aimed at people who are in their, approaching retirement or in retirement and are looking for some sort of a resource that they can depend upon to provide them some ideas and exchange views and so forth. And that's what this chart really is all about. I just wanted to mention a couple of things. There is a website that the Portland chapter maintains, and here's the link for it. And on that site, by the way, we have set up a page, thanks to John Wong, who's our web guy. And there's a list of all the presentations that go back to April of last year. And there's videos of those presentations. So you're welcome to enjoy them. The SIG presentations are also listed there as well. As you can see, we've had some very good speakers over the last 10 months. And going forward, we hope to have more. So just be aware of that, and you're welcome to visit that site. There's no charge for it. And you can download or watch Zoom videos basically for any of these speakers. We have ones on REITs, we have ones on dividend investing, we have one on income investing with Steve Bravia. Brian Livingston did one on his muscular portfolios. There's all kinds of content there and well worth looking at. Okay, just a few rules about the Zoom meeting here that we're going to go through. Just a few etiquette rules, basically. Make sure that your mic is turned off so that we don't hear the dog barking and, your wife yelling at you or anything like that. And then, if you want to ask a question or type a question, there's a chat function in the lower right corner of the screen. You can type your questions there. And we'll be happy to, then Tom will kind of act as our little moderator for that function when we get to it. And there's I think everybody knows, if you're not familiar with Zoom, the microphone is down there in the lower left-hand corner. And so you keep that off basically if you're not using it. And then here's the chat function, which I described earlier. And if you want to raise your hand or ask a question, you just click on that icon there. Okay, and you don't have to have your camera on. We don't need to see you unless you want us to see your place, but that's optional. Okay, I'm going to stop at this particular point. Todd Blickenstaff is going to be our speaker. Todd, did you want to mention something about the upcoming meeting before we get into the actual your session thing?
Let me unmute myself. Thank you, Andy. We do have a meeting coming up this Saturday. It's our regular chapter meeting that we do about every couple of months. And we're very pleased to have Dr. Marvin Apple speaking with us. We had him present at our May 2019 meeting, did a great job. I heard him at the national conference in 2018. And he's going to be presenting on the outlook for the markets in 2021, given the election results and what areas of the market may be more favorable for investors going forward. And so interested in having Marvin share his perspective on that. In addition to fundamentals, he's expert technical analyst, and his father created the MACD, the moving average indicator that's used so commonly in technical analysis. And so looking forward to his presentation. Encourage everyone to attend that meeting. It's going to be video only. Of course, we're not doing in-person meetings, as everybody knows. Don't have the green light on that yet. But it starts at 9 a.m. I think everyone should have received a email invite to that meeting by now, and a reminder should go out this week too. And if you can't find an invite, let us know. But we're looking forward to that. And so that will be 9 a.m. this coming Saturday on Zoom. So thank you, Andy.
Okay. Todd, I think I would just turn it over to you, and I'll switch over to the slides that you sent me, and then we can go from there. Let me just do that. And I will move over to the slides here. Let's see there. And there we are. Okay. You're on, so to speak. Go ahead.
Okay. Thank you very much, Andy. And I decided to do this presentation because we had a dialogue going on a couple of months ago, going back and forth about the outlook for and some discussion on previous meeting about using mutual funds and ETFs for income equity investing, which is kind of the phrase used in the business. And I spent most of my career as an investment advisor to describe, obviously, as is the goal of this SIG chapter, as Andy explained a few minutes ago. We're interested in income-oriented investments, be that coming from equities or fixed income or other vehicles to provide current income and cash flow. And so wanted to speak about that. This next slide, Andy, this is just my bio briefly. Again, background in the investment business. I manage investment portfolios predominantly for high net worth individuals, but also complex trust, charitable foundation, employee benefit plans. Manage a tax efficient investment program that we launched for U.S. Bank's Asset Management Group, and also managed a bond mutual fund. I've been active in real estate investing and consulting. Currently now retiring from investment business. Okay. Page here.
Next page, okay.
Okay, here's income. And one of the things I wanted to focus on, that interesting topic, is because the way the investment offerings have evolved in the industry is that we tend to think of course, the variety of fixed income or bond investments. But on the equity side, when people think of yield-oriented, income-oriented investments, they tend to think about large cap stocks to the exclusion of other categories. And there's more offerings in the large cap arena, particularly the domestic arena, than ever before. A lot of choices there, but it's not just limited to that any longer. And I think it's important to point out that there are opportunities in other subsectors of the market, which include domestic mid cap and small cap. We also have international large cap, emerging markets large cap, and of course in international and emerging markets, there are those categories that have mid and small cap equity exposure as well. And so make people aware of that. Of course, the emerging markets tend to be those countries that are smaller, not as, we differentiate between, in the international front, between developed markets like Europe, Australia, and parts of the Far East, and the emerging markets nations, which tend to be a lot of countries in Latin America, and Africa, and some in other areas, but also surprisingly, China is still categorized, mainland China, as the markets nation. Of course, that's been debated in politics. Of course, one of the biggest countries in the world, one of the biggest economies in the world, but it still gets categorized in the emerging markets. So if you're investing in investments with Chinese exposure, it's you're generally participating in emerging market investment vehicles. So, okay, and I should also point out that one of the things that has really changed, I was in the investment business over 30 years, and when the definitions of what were large and mid and small cap equities, when I first went, I got some noise in the background there somewhere.
Be sure your mics are turned off, everybody, please.
We had small cap used to be 0 to 5 billion in market capitalization, which of course the number of shares times market price per share. 0 to 5 billion for small cap, 5 to 10 billion for mid cap, and 10 billion plus for large cap. But now, in this day and age, we actually have 4 categories because we have small, mid, large, and we've got mega cap stocks, the huge companies, the Microsofts and although their market cap is shrinking. And so now these days, the categorization of small cap is 0 to 15 billion, mid cap, and these aren't set definitions necessarily in ink. You'll see people use different categories, but broadly speaking, and then mid cap are 5 to 25 billion, which used to be large cap. Large cap are 25 billion plus, and then the mega caps are above that. You get 150 billion for some of these companies. And basically, so what we've had is market capitalization inflation. And people still think, well, large cap, that's the only place I can get dividends and equities, which definitely isn't true because, basically, it's not your father's mid and small cap, definitions any longer. They've really grown to be larger numbers to reflect the larger market capitalizations in the markets, particularly in the U.S. And it's also, people have focused on thinking that, okay, well, large cap, that's where the action has been. But it's not actually categorically, it's not really true. That's really deceiving. And if we actually flip to the next page, and this is, if you can enlarge this one a little bit, Andy, that would be great.
Okay, I'll try. Okay.
This is some information. I've pulled together some information from different sources. Frankly, have better presentations than I do on some of these categories. And mid capitalization stocks have actually been, and I have to admit, I have a pro mid cap equity bias. I think it's an area of the market that gets overlooked a lot because a lot of the large cap and mega cap names we know here in the U.S., including the mega cap technology companies, Facebook, Google, and Amazon, those companies are mega cap companies, and they tend to dominate the news, and they've also performed very well for those specific areas, particularly the technology companies. But for broad brushes of the market, actually mid-cap stocks have done better over time. This chart really shows this for going from left to right, rolling 12 months, for 36 months or 3 years, 50 months or 60 months for 5 years, and 120 months. Mid-cap stocks were among the leaders in most of those categories. And so, but there's not as many mid-cap companies that are household names that you would know just because they don't get the attention of other categories do. But really, they've done really well. They've actually outperformed large cap, and they've outperformed with only slightly higher volatility, and they've also outperformed small cap stocks with less volatility. And so this is an area that doesn't get the attention it deserves based on based on historical market returns. Now, if we move to the next page here, Andy, and if you have it, okay,
That one?
large
Is this the one?
enough, I think, to see. This is basically showing if you show this cap gap here in the center of the page, the Russell, and that's basically showing that equities between market capitalizations of 14 billion and 24 billion oftentimes get overlooked, but it's a top performing sector. And so that's, you know, and there are ways to participate in that sector of the market. And so we'll talk a bit about that. So, okay, let's go ahead and move to the next page, Andy, if we could. And yes, here we're talking about if we're comparing, you know, international to domestic equities. And so the, if we look at this and we look at the valuations for equities, because one of the things, you know, we've heard about it for at least the last 5 years. Most of the market recovery that we've seen in, you know, since 2008, 2009 has been, you know, publicized large cap stocks, you know, relatively, you know, few leaders driving the market, as I mentioned a few minutes ago, and you get you get less broad exposure in some of the large cap equities, particularly if you buy into capitalization weighted exchange traded funds or mutual funds that might be capitalization weighted. You end up with less broad exposure. You don't get much cyclical exposure because you have such a concentration in technology companies. And so what this chart shows is you've got basically the cyclical exposure is less in the US for the S&P 500. That's basically the rest of the market excluding technology. And then, but if you look in EFA, which is a proxy for, again, basically developed markets international, that's only 41%. You have 41%, excuse me, of cyclical exposure. And in emerging markets, 37%, significantly higher. So basically, you're more broadly diversified if you just buy a static index in Europe or in the emerging markets. And if you look at valuations, which is on the right side of the page here, and you see the price earnings ratios and where they are to the mean, you know, if you look at the MSCI World Index, which includes the U.S. and everything else in the world, and you see where the valuation levels are relative to the mean price earnings multiple, you can see that on the right-hand side, well, the U.S. is significantly more expensive than the broad world markets. It's about almost 11% premium. But then if you go to the left side of the page, you can see that Europe, Australia, those are have a or a 10% discount to the overall PE ratio, and that you look down here to emerging markets, that's at a full 30% discount to the mean valuation in the world. And so you're saying, wow, that's a lower valuation. And also, by the way, the prospects for growth in emerging markets are significantly higher than they are for the domestic markets here. And that's something also that makes sense. But one of the things we run into is, okay, well, how do I participate in that? If I'm a more conservative investor, I'm not really a speculator. I'm looking for income and cash flow, again, which are the focus of this SIG group. Well, there are ways to do that, and we'll get to that in a few minutes. If we could move to the next page, Andy. Somebody emailed they'd like to have you expand this as large as you can so that everybody can see the screen. I know it's in the chat box. But if you look here for the key markets here, if we look at the S&P 500 at the top of the page here, and you can see that basically the top 5 companies the market represent almost 23% of the total market. And so, and that happens to be, and it shows you right here, Apple, Microsoft, Amazon, Alphabet, and Facebook. I mean, that's a huge percentage of the overall large cap market, the S&P 500 consists
I
of
mean, did it talk to you?
stocks. And I'm sorry, somebody's saying something in the background. And then, but if you compare that to the EFA index, again, the developed market, international markets, you can see that that concentration is significantly lower than it is there. It's only about, it's less than 8%, and it lists the 5 companies that are the largest. You probably heard of a lot of those companies. And so, but if you look at so you're not only that, you're overly concentrated in the U.S. The U.S. is selling in a significant, in the previous slide, and we see that U.S. and the right chart on the right-hand side of the page shows U.S. stocks weight in the MSCI World Index for the largest it's ever been. It's almost 70%. And so, and one of the things to point out, and it's important to keep in mind, is if somebody buys an exchange traded fund, they may be more concentrated than they realize. We'll talk about that a little bit more as we move on as well. Andy, if you could move to the next page, please. Okay, thank you. And so this basically shows, and I'm going to focus on the chart really on the left-hand side of the page, and it shows the market value of the 100 largest U.S. companies as a percentage of all of the non-U.S. developed markets, and it's at the highest valuation that it has ever been. So again, U.S. stocks have done well. They've done better than international has significantly, and not just for the last 5 or 10 years, but really going back 20 or 30 years. And but just because it's been that way in the past doesn't mean that it's necessarily going to be that way going forward. One of the things that I learned early on in the business is most people in the investment business believe in broad diversification and that you ought to own these different sectors. I will tell you that because of the many years of underperformance by international and emerging markets in the past, I tended to underweight those in clients' portfolios as much as I could because they were a lag. They were dragging the markets down, and they weren't keeping up with U.S. equities, and so I would have a higher weighting in domestic equities and a lower weighting in international and emerging markets. But again, just because it's been that way in the past does not mean it's necessarily going to be that way going forward. And Andy, if you could move to the next page, this shows, you probably read about in the financial press, this has been getting a lot of attention here recently, and deservedly so, is the weakness of the US dollar. Now, I don't want to get into a full debate on fiscal responsibility or the lack thereof here in the US, but we're not known for running a fiscally tight ship here. Even, excluding the pandemic this year, prior years. And there's been a huge level of spending. A lot of that's designed to stimulate the economy, keep interest rates relatively low, near zero. And, but the U.S. has been, the key international currency, the standard that people look at. But because we're running such huge deficits, because we're spending so much, and again, it can make sense, particularly, when we're in economic years. So think of the spending, debate about it in the newspapers, but what that may be a factor in contributing to weakness in the U.S. dollar. But what happens when we get weakness in the U.S. dollar is when we buy international securities, either if they're developed markets or emerging markets nations, you transfer that from their local currencies back into the U.S. currencies, assuming you don't hedge the currencies. That you get a bang for your buck there because the U.S. dollar is worth less relative to many of these international currencies than it was last year. And so, and we're getting back to levels where we were in, 2016, 2018 with a relatively weak dollar. And if that continues, that could be a boost for international equities conversion. It also can help in commodities, but we're not going to discuss the subject of commodities today. So, if you look here also on the chart on the right-hand side of the page, what you see is again, weaker dollar boosts international equity returns, but it is a drag on domestic returns. You can see that on the left-hand side of that chart, it shows the weaker dollar periods like we had in 2002 to 2008. You had domestic equities lagging a bit during those years. They made it up for it later on. And then from 2011 to 2020, when the market got back up on its feet with the stronger dollar in market, you can see that the U.S. equities represented by the S&P 500, which is the dark blue bar, significantly outperformed EFA and emerging markets equities, okay? But we may be switching back to an environment with a weaker dollar like we had in 2002 through 2008. And given that kind of environment, it's a good time to have more exposure in international equities, being either developed or emerging markets or both. If we move to the next page here, this is, Mandy, I apologize, maybe you fixed it, but I put this chart in twice in the original draft. So we'll just focus on one of them. And I won't spend a lot of time here. This chart has a lot, it's pretty busy, it can give you a headache. I'll just tell you, basically, if you focus on the categories at the bottom of the page here, that just shows you which years, which equities outperformed. The U.S. stock market didn't necessarily outperform every year, and particularly large cap. There were areas where emerging markets were up some years. As we pointed out, it's another way of looking at the slide on the previous page. It just provides more detail and shows global stock and developed internationals have also had their day in the sun. So that's important to note. So let's go ahead and I wanted to mention something about emerging markets before we switch to this page. And that is, there's significant reasons why emerging markets may outperform going forward. And people think of emerging markets like, okay, well, there's, their raw materials markets like Latin America produces, or their utilities, or their basic industries. But really, emerging markets has, a lot of participation in technology companies, up and coming technology companies. Some of those companies, are getting a lot of press, particularly some of the Chinese-based companies like, Huawei, and you've also got Alibaba and Tencent and companies like that are major, basically are the international equivalents of Amazon.com. They're doing very well. So the U.S. does not have any kind of monopoly on fast-growing technology companies anymore. There's a lot of exposure available overseas. We already talked, another factor is emerging markets look cheap. We saw the valuation levels of the discount, 34% discount to the median price earnings ratio in the MSCI International Global Index, and emerging markets are growing much faster, and they also tend to do well when the Federal Reserve, the domestic Federal Reserve, is in an easing mode, and certainly they are, and they have been. And basically, we had the current Fed chair come out and say recently, basically, we're not even thinking about raising interest rates for at least 2 years. It's probably 2 to 3. I mean, he's just been that graphic about it. And so that means that, don't look for interest rates to rise significantly. That doesn't mean the Fed controls everything. They can't control the long end of the curve, yield curve necessarily, although they've been involved in that the last couple of years. But they are basically, pursuing a dovish type of investment strategy, keeping interest rates low, and that's not going to change anytime soon. And so also, if we do get trade agreements solidified, that's been a contentious issue. I know during the Trump administration, it's still a big issue with Chinese relations, particularly throughout the world. And so, but international trade is important. Emerging markets tend to do well when global trade is strong. Go ahead and move to the next page. Andy, yeah. Okay, actually, we're going to flip past these next couple of pages.
You want to go past them?
Yeah, we're going to go past it because I was just summarizing
Okay.
points on those.
By the way, I'll put these on the website so that they're available for everybody.
Yeah, and I'm going through this material pretty quickly, and again, these materials will be available. This is the one I put in twice, Andy, so you can go
all right.
as well. by mistake. Okay, here we are. Now we're on the right page. And so, okay, as we talked about, well, I made the case here for, and again, I have not been a long-term international and emerging markets bull, but I'm getting a lot more bullish now on this. And there's a way to participate in these markets while owning income equity-oriented securities. And because we've had particularly a proliferation of exchange-traded fund offerings that have come out the last few years, this has created a lot more opportunities, more choices in international and emerging markets. And when I say international emerging, I'm really referring to developed and emerging. It's just some of the terminology we use. But now it is possible to have income equity vehicles in all of these categories. And that includes large, mid, and small capitalization in the international and emerging markets. And I'm kind of simplified this presentation today because I'm using exchange traded funds for some of the, for example, here, I happen to be a guy that has a lot of actively managed funds as well. I'm not a believer in everything should be passive just because it's cheaper. But for simplicity purposes here, I wanted to compare apples to apples, use exchange traded funds. In fact, I'm going to use for this example here, exchange traded funds from one particular family because they have a lot of offerings and basically cover the waterfront, so we can make that case. And I know there's a lot of good funds that we've seen the communication going back and forth between the SIG group members, that they own a lot of them already. So I know that a lot of you are familiar with these offerings and have your own choices, but I want to kind of make the point by showing examples from one fund family and just exchange traded funds for purpose of this illustration. Everybody's aware of the advantages of exchange traded funds, additional broad availability, low expense ratios, low minimum account purchases, basically no transaction fees normally, since fees have been driven down so significantly, tax efficient for when you have them in a taxable account environment, can be traded on any investment platform, basically, and offers opportunities beyond capitalization weighted funds. Talk about that and more in a minute. There's passive funds, traditional exchange traded funds. Exchange traded funds are one category of closed end funds, but they have traditionally been passively managed. In other words, designed to mirror an index, but that is changing now. And there's some that are actively managed. Some use factors, smart beta funds, and then modern alpha funds, like the funds that we're going to talk about. Let's go ahead and move to the next slide if we could, Andy. And so I selected WisdomTree for purposes of this illustration because WisdomTree, and I don't work for WisdomTree, I don't get any compensation from WisdomTree, never did, but I am a fan of their exchange traded funds. And one of the reasons why is, and I alluded to this in one of the previous slides, is the concentrations in some of these indices, particularly in the domestic front. When you can have basically 5 companies make up almost a quarter of your entire investment portfolio, what happens to those portfolios and those funds that are weighted that way if one of those stocks significantly weakens? For instance, Facebook, one of the biggest holdings in the S&P 500 and also the NASDAQ, if that gets a haircut, that can have significant outsized impact on the fund holdings. And frankly, I don't think a lot of people who buy passively managed exchange traded funds, like the SPY or the QQQ, are thinking that it's a momentum play. But because of those concentrated positions, that's what you kind of end up getting to a certain extent, very concentrated portfolios, and they can have outsized returns, good or bad, depending on what happens to those 5 companies that make up a significant portion of your funds. And I've seen exchange traded funds are actually more concentrated than that. Some have up to a third of the portfolios in a limited number of 5 or 6 companies. So that can be a pretty rocky ride if they're not performing well. And basically what those funds do is they just buy more of what's going up. And it keeps driving that way. And it worked, as they say in the investment world, it works well until it doesn't. And you never know when it does. And this is, since we're income-oriented investments, cash flow-oriented investments in this group, I don't think that capitalization weighted funds are the best choice. And so, and what WisdomTree does actually is they've used equal weighted funds and fundamentally weighted funds, and for purposes of our discussion here today, dividend weighted funds. And so they will actually overweight the funds that follow these dividend oriented strategies and do that. So that you get a higher yield for those specific funds, because they figure, well, the investors that are buying these funds, well, they want to generate income and cash flow. They're not just after appreciation fundamentally. Want to see appreciation, but that's not necessarily the primary objective. And then they will also rebalance those funds based on valuation criteria. In other words, if one stock gets to be a higher percentage, then you sell some of that and invest in some other stocks that are not as highly valued. And so, and one of the things that when I selected, what I did is basically went through here and selected a variety of funds from the WisdomTree platform to show that are dividend oriented. Some were for current yield and some were for dividend growth. And I think that's an important differentiating factor. I know we talked about that in other meetings and presentations, and in the SIG group meeting format. Let's go ahead and move to the next page if we could, Andy.
Todd, did you want to take questions as we go, or do you want to wait till after?
Let's see. I tell you what, I can. Well, I'd actually prefer, because we still have quite a bit of material to wait until we take the questions that we get further along, if that's okay.
All right. Fine.
Okay, this is dividend growth. And one of the things that and we've talked about it again, I know before in this group, is the long-term appeal of, Andy talks about every presentation, every meeting, the long-term appeal of companies that consistently increase dividends. We've all seen Andy do the test and say, okay, based on this, are these companies, are their dividends sustainable? Can they continue to grow them? What happens if we're in a downturn? What happens if we have a recession? And certainly we've seen some companies, given the pullback in the economy this year, have to trim some dividends. So it's real important to emphasize those companies like the dividend aristocrats that are able to not only sustain their dividends, but growing forward. So this shows an example of that. And there's a lot of companies that qualify for that. And it's can you move us down on the page a little bit further, Andy? Yeah, thank you. And so, and this shows basically that the dividend aristocrats have done very well over time, higher rates of return than the S&P 500. This shows basically a 15-year period. My dog crying in the background, I'm going to have to let her out in a second, is a 10.1% return versus a 9% return for the S&P 500, also with lower volatility. So a win-win situation in that particular case. And so also, give me pause 1 second here. Golden Retriever Kenzie, who really runs the household here, truth be told. So that's to the, if we could. Next,
do you want to go to the next slide, or?
Please.
Okay.
And this shows that, one of the things we talk about in the investment business especially, is up capture and down capture ratios. And so here's an example. Obviously, those companies that can sustain that growth will tend to basically capture about 91% of the return that conventional equity, like an S&P 500 type portfolio would do in an up market. And, basically, give up less on the downside. So down capture ratio, still will retain more of the return. So that's an important consideration, dividend growth. And so basically, I know everybody understands these concepts, but that's why I chose funds in each of those categories for basically large cap, domestic, large, large, mid, and small, developed markets, large, mid, and small, EFA emerging markets, large, mid, and small, one dividend growth fund, and another fund that is dividend oriented and tends to have a current high yield. And thinking of that, the dividend growth funds provide some ballast for that are probably less likely to be impacted on the downside in a market pullback. So, okay, so let's go ahead and move to the next page, if we could. Okay, and this is where we talk about the basically. I mentioned a lot of in most exchange traded funds are passive oriented funds. You buy a static index, they might trim it once a year, that kind of thing. But the active management has come to the exchange traded funds world, and you've probably read about some of these. Some of you may own some of those. And basically, you know, it's called, you know, smart beta funds is a term that gets used a lot in the exchange traded fund world. And so that's where modifications are made with managing those funds and making adjustments in the funds. And now active management is more expensive than passive management, which is why you will see higher expense ratios on actively managed funds, whether they be mutual funds or exchange traded funds. But what WisdomTree tries to do and is to have a modern alpha stretch where they do it very efficiently and manage very tax efficiently, so the net cost of the investor is lower and expense ratio is still manageable. It's less than a conventionally managed mutual fund, actively managed mutual fund is. So that's how they approach it, and it's worked out pretty well for them. Some of you may have heard of Jeremy Siegel, famous investment prognosticator, comes from an academic background. He's actually advisor to WisdomTree and gives a lot of input there. And so, and the next page, if we move to that, and we talked about domestic dividend strategies. Again, this is another where we emphasize that with this particular strategy, they emphasize domestic dividend strategies as well as international. And they actually weight, so rather than capitalization weighted with the largest positions, what they will do in managed portfolios for the WisdomTree funds that are dividend oriented. Why don't we move to the next page, Andy, and I'll show that, because we have a chart that shows that. If you wouldn't mind moving to the bottom of the page first, and then this is an example of it's small. It's small type, and you really can't see that very well. So thank you for enlarging that. But basically what it's showing is with a conventional market capitalization weighted strategy, which is in the center of the page under the black box, is that those companies are weighted based on appreciation potential. And so you take a portfolio here that's where you've got 3 different companies with dividend yields respectively. This is in the 4th column from the left, that yield 2%, 6%, and 7.6% respectively. Okay, and if we then look at, you look at dividend generation if they're weighted based on capitalization of the companies, the specific companies, because you see in the 2nd column from the left that the market capitalization varies from those companies. But I don't want to get too bogged down in the details, but basically what it shows there is a standard capitalization weighted fund, in this example using just 3 companies for illustration purposes, generate $4,630 worth of income annually. Now, if you weight these companies instead by dividend yield, you end up with higher weightings in those companies, specifically companies B and C, that have higher dividend distribution rates, and they are the companies that get overweighted in this dividend weighted strategy. And so that you basically, all boils down, soup to nuts, is you end up with a higher yield in that strategy of $5,988 worth of income versus $4,630 in the standard capitalization weighted strategy. And so it's designed to say, okay, you want more income, we're going to give you more income, and we're going to weight the underlying investments in these exchange traded funds to provide more income for you, a higher net yield. So that's an example of how they do that. And then the next page, if we could, Andy, and this is basically how they do it at WisdomTree. They rebalance based on valuations. And so again, you get less of the impact of owning a pure momentum strategy like a conventional capitalization weighted ETF gives you. And you're basically rebalancing the portfolio to increase the allocation to companies that have higher yields, recognizing you might get higher rates of appreciation with companies. And not only that, some of those companies that have lower yields may have more appreciation, but you can sell those, reduce those weightings, and buy more companies that have higher yields, like we saw in the previous situation. So it's managed towards increasing your dividend yields there. And so we can move to the next page here. And in this page, it talks about, this just lists, I'm not going to dwell very long here, it lists the entire WisdomTree offerings here in this and the second page. And basically what I did is select funds, and I use Morningstar Premium in my fund analysis, which I highly recommend. It's a really good service. And it basically boils down the company, looks at the ratings of mutual funds I'm looking at, as well as exchange traded funds. And I chose those funds, again, equivalent to two dividend funds per sector, one dividend growth, one more just, high dividend yielding funds, and emphasize those funds. I did some additional analysis in Morningstar Premium and select those funds that tend to be 3 or 4 star predominantly to fill out the portfolio in each of those categories. And so if you want to show the second page here, Andy, the second slide, that shows the balance of the different funds. And, and again, I didn't use any alternative investments. I didn't use any fixed income investments in this particular category, because what I wanted to do was really show, okay, to compare apples to apples to like an S&P 500 type portfolio, let's put this all in equities. Not that you would necessarily have that for your asset allocation, but we wanted to show how much income can we produce from an all equity portfolio that's broadly structured between domestic and international equities. And so if we move to the next page, if we could, Andy, this is an example of how we did this. And what I used here is I didn't actually use asset allocation recommendations from WisdomTree. I used BlackRock's allocations. For those of you who may be familiar with BlackRock, they're the largest investment manager in the world. I work extensively with BlackRock and a couple of firms that I work for. They do excellent work. Full disclosure, I own their stock. I think it's a great company. And but they basically, what I did is I took an allocation for their global allocation, and I actually substituted equity equivalents for the bond categories that they included. So I messed with that. I altered their allocation because I wanted to convert it to an all equity allocation, see what it would look like. And as I mentioned, then I substituted dividend yield and dividend growth stocks in each subclass. And I also, one of the nice things about Morningstar Premium is, I can set it up as a model portfolio for formatting, analytics, and performance measurement. That's some of what I'm going to show you now in the presentation here. And this is, and I know this is small. I don't know how much you can enlarge it, Andy. This is just a standard report. Thank you. It's a good thing he's doing this instead of me. But what this ended up doing is I wanted to show, again, a broadly investment portfolio. And so this is showing basically, oh, I got to plug in my computer. I see batteries running low. And this is a portfolio that's weighted 2/3 in domestic equities and 1/3 in international. That's an aggressive weighting, I admit, but I think it's, because we're emphasizing dividend yielding equities in this model, that it offsets some of that volatility, because as we saw earlier in illustration, higher yielding equities tend to give up less in market pullbacks. and where those with limited dividend yields tend to get hammered more significantly in market pullbacks like we had in the spring of this year, as an example. If we could move to the next page, and we could keep that enlarged as well, Andy. This is an example of what how we diversified this, and it breaks it down here so you can see. Okay, we already said it's 2/3 domestic, 1/3 international, which includes development and emerging markets, and it shows the categorization here about an 18% allocation to Europe, which is 12, almost 13% Europe developed. There's emerging markets countries in Europe as well. Then we get down to Greater Asia, and of course you would expect in emerging markets, because that's where a lot of the growth is coming from. We've got a pretty significant weighting in Asian equities, including Japan, Australia, Asia, and Asia established and Asia emerging. So there's China, which is not broken out separately here, but it's a big part of the underlying allocation for this portfolio. Okay, and if we move to the next page, and so you can see that what we have here is what's called the X-ray feature. Some of you may have used this if you've got Morningstar Premium, where you can actually drill down the investment portfolio, see the underlying equities. And basically what this is showing is, as you would expect in a dividend-oriented portfolio, is that we have larger weighting in value and core equities and more limited in growth, because you're not going to get growth-oriented companies real high dividend yields. That's not their focus. So it is definitely a portfolio that's tilted more towards value and core equity investments. Okay, and on to the next page, Andy, if we could. This is a slide that has a lot of things consolidated. This is the X-ray overview for this equity portfolio. And again, it's showing you, just highlight a few things we haven't already seen. Again, U.S. stocks 63%, international stocks 37%, all equity portfolio. You move to the center of the page at the top, valuation, exposure, emphasis, and value, and core categories that offer higher dividend yields, much less exposure in international, less exposure in growth. And so we only have, for instance, 2% allocation to mid-cap growth companies, and 2% in small cap as well, but pretty significant exposure in value and core in those categories in large and small. So this is designed to be broadly diversified among market capitalization and broadly diversified among equities, domestic and worldwide as well. So, if you go down here to we move to the right, yeah, that's great, Andy. You can look over here to the right and see that basically dividend-oriented stocks, which come under the high yield category here, are about 61% of the portfolio. You compare that to the S&P 500. I know this isn't apples to apples, because we have international in addition to domestic, and we're not just purely domestic, but it just gives you an idea. High yield, much less exposure in the S&P 500. Something else I wanted to point out here also, we have much less exposure. Well, actually, we're going to show that by industry. If we look on the left-hand side of the page, and if you could go down a little bit, Andy, too, so we can, yeah, that's great. Okay. If we, technology, which is volatiles here, the technology is about 10% of the portfolio versus about 24% for the S&P 500. So, more higher dividend paying stocks is going to result in a lower technology oriented weighting. And so also, if we go down here to the lower left-hand side, I wanted to show the expense ratios on these assets. So overall, this is about 41 basis points that we're paying for the underlying funds, which is a pretty low expense ratio for a globally diversified equity portfolio, because I can tell you, because I own quite a few actively managed funds where I'm paying up for the management, and I'm happy to do it because I've got some exceptional managers. But their yield, their underlying expense ratios are anywhere between 130 and 2%. Some are even higher than 2% domestically. So this shows you that you can achieve diversification using exchange traded funds, and some that are using the basically modern alpha strategies like or beta strategies that other competitors are using, like ProShares, for instance. And you can get a lower expense ratio and get your diversification that well, and they're at least partially diversified, in terms of, or partially actively managed. And you can make up for some of that lack of active management as well by being as broadly diversified as this particular example of this portfolio shows you. If we move to the next page, Andy, and here we've got basically showing the statistics for the equities in this portfolio. And what it's showing is this portfolio, and looking on the left-hand side of the page, price earnings ratio 14 times. That's only, and what it's doing is percentage of that compared to the S&P 500. The price earnings ratio of this portfolio is only about 2/3 of what it is for the S&P 500. Price to book ratio at 1.75, only about half of what the S&P 500 valuation level is. Return on assets, 5.85. That's still a decent ROA figure, and it's about 2/3 of the S&P 500. And then return on equity, also 2/3 of what the S&P 500 is doing. We get a little lower return on equities because we're emphasizing dividend growth a bit more. And then if we look in the right-hand column here, we see projected earnings per share growth is, pretty relatively close to the S&P 500. It's 0.87 times, almost 90% of what the S&P 500 is doing. Some of that reflects, hey, we're owning emerging markets in particular that have higher estimated growth rates than domestic equities do. So that's a good thing. We're getting good bang for our buck. And if we look at the overall portfolio yield of this portfolio, it's 2.81% is the yield. And that's not, maybe not a number to make us jump up and down, but it's in terms of high yield, but it is higher than the S&P 500, about 1.9. And because I emphasize dividend growth funds in each of these categories, or at least a half of the allocation, we get a lower overall yield than if we just emphasize high dividend paying companies. But we're also getting that dividend growth, that compounding effect of that. That can be significant over a period of time. As we also pointed out earlier in the presentation, they tend to be more robust, less impacted by potential dividend cuts, give up less in price pullbacks. And so I think that's going to understate the overall yield of the portfolio. If you have a portfolio like this for any period of time, and because you're going to get that compounding effect of basically dividend appreciation, because you're owning companies that are raising their dividends on a regular basis, kind of like the dividend aristocrats do domestically. And then the next page here, which actually is maybe more of an illustration of the underlying, workings of the X-ray function of Morningstar's premium service, is there's actually comments here where the portfolio, they would do some analysis and tell you things. And so, for instance, it'll say over here on the right-hand side, your portfolio style is unclassified. We didn't emphasize one particular strategy, no, because we're broadly diversified. And so, we don't fit one style category. The portfolio is aggressive here on the left-hand side because of the asset allocation mix. We don't own any bonds, for instance, for that purpose. And if you want to move down a little bit for the second half of the page, Andy, you can see that we have, again, as I told you earlier, very little exposure in technology. We're underweighted there. We have a lot of exposure in categories that are more yield oriented. Again, 61% here under the high yield category on the right side of the page. Classic growth, aggressive growth, underweighted significantly because, again, we're looking for those companies that are going to provide us with attractive dividend yields as opposed to capital appreciation as their only consideration. And so, and I think let's move to the next page if we could, Andy. And here we looked at the, we're heavily weighted in Europe and Australia and emerging markets as the analysis points out. Yes, that's deliberate because that's where the growth is. And the nice thing about that is we're getting dividend growth in those areas with fast growing underlying economies. And we're probably going to have pretty decent price appreciation in a lot of those companies too, because it's just represents faster growing economies that can raise their dividends, but also generate some healthy earnings growth. So we would expect to get some decent earnings growth in this portfolio, as well as dividend growth and attractive dividend yields to start out with. And so, okay, let's go ahead and move to the next page. I will tell you that Morningstar Premium will actually show you, and this is actually, showing you one page of a 33-page report where it shows you what are the underlying companies that you own. And so it starts out with the largest here. So, if we add up and average all of our holdings in these different funds, the largest holdings in this portfolio include Verizon Communications, Altria Group, Pfizer, Coca-Cola. Down here a little bit further, if you want to page down, Andy, there's Rio Tinto, Microsoft, AT&T, Apple, Philip Morris, and GlaxoSmithKline. So we actually have a technology company on our list here, Microsoft, because they've got a decent yield. And so, so it's nice to be able to drill down into these portfolios, particularly with exchange-traded funds that may not have as as much transparency to see what the underlying holdings are. And then, didn't want to go through 33 pages of that. Now, if we move to the next page and we show performance, what I'm doing here is let's look at the return of this portfolio. This is trailing 12 months. I couldn't find this for a longer period of time, but obviously this has been a pretty volatile year, albeit with an uptrend, but some pretty good pullbacks in the spring and some pullbacks in the fall as well. Excuse me. And so this shows what this portfolio has done if we had owned it on January 1st, 2020, relative to the Morningstar U.S. Market Index. This represents all domestic companies. And we've lagged that a bit. Keep in mind, the U.S. Market Index, that's going to have a lot of growth companies in it. It's going to be capitalization weighted, so it's going to have those big 5 or 6 technology companies that make up a good portion of the portfolio. So based on total return, no, we're not going to necessarily match that because the growth has outperformed value, and it's been doing that for 10 years now. And it's always a question of when value might take the lead again. But again, we're looking for income, we're looking for dividends and dividend growth, and we're going to get that more in value stocks than we are in growth stock. But if we move on to the next page, actually, Andy, and we look at this, now this is showing us the return of this portfolio, if we don't know on January 1st, again, over the last 12 months relative to the Morningstar U.S. Value Index. And you can tell we're pretty much neck and neck as far as that goes. We're right in line with the index return. It's varied by month to month, but it's pretty much in line with a domestic large cap index. And that's in a market where, okay, international or domestic has generally outperformed international equities. Lower emerging markets have done well this year, and it started to shift that where we're getting more outperformance from international emerging markets in the last quarter of this year. Again, that weak U.S. dollar effect and the fact that we've seen broadening out of the market internationally, where we had a more narrow market when the market came back in April and May from a lot of the early sell-off, but it's starting to participate more broadly, both domestically and globally. And we've also seen a situation where, again, the weakness in the US dollar, that converts those international returns to higher rates of return for US investors following that positive currency conversion effect with the US dollar relatively weak to those international currencies. And so it's done pretty well, but this is just a short-term time period. But what it does show you is that it is possible to diversify broadly, domestically and internationally, and by market capitalization. Again, you know, there's times when mid and small cap equities do as well or better than large cap equities. And you can still get that dividend yield, higher dividend yield and some dividend growth if you look for those investment vehicles that can do that. And of course, again, I think it's and I selected exchange traded funds here again to keep it simple. I use one fund family, but I think that has good rules of the road in terms of diversification. And also, it is easier to own individual companies in the domestic large cap space because they're more familiar, they're easier to analyze, they're followed by more analysts. And but when you get into the mid and small and even the micro cap categories, boy, you know, it's much tougher to have a handle on those companies. And frankly, I'd rather have an investment manager picking those companies for me, but while still making sure that I'm broadly diversified. And again, you can do it at a lower expense ratio with exchange traded funds with semi-active management. Again, modern alpha strategy is what they call it here. Smart beta for somebody like ProShares and some other families. And but you can also do it actively managed. I could have easily chosen some of my favorite active managers to put this portfolio together, but I wanted to just, you know, apples to apples comparison, and we do it at a low cost and to achieve that diversification. So that's kind of what that's all about. I've been talking for a long time, fast clip, so this is a good time to take any questions that, or comments that anyone might have about this portfolio and the analysis that went into it.
Tom, you want to take a look at what's on the chat list and see what's going on there or anything?
Sure. We've got nothing on the chat list, so I think it's probably best to just do this verbally and have folks ask some questions.
Okay. Okay.
Did I talk too fast?
Yeah. Well, yeah. So, you know, if you want to ask a question, by all means, just turn on your mic and, you know, ask Todd any question you have in mind.
Todd, this is Tom. I got one. That was kind of like drinking through a fire hose. A lot of good information.
I realize, yeah.
But what are the, you know, 1 or 2 or 3 takeaways from this, particularly, you know, for an individual investor?
Okay, well, number 1, I would say is don't just think domestically when you think dividend, income yield, and cash flow, that you can do that internationally. And so don't exclude international equities when putting together the equity portion of your portfolio. Second factor, don't assume it needs to be all large capitalization, because you can make significant money in mid and small cap, both in domestically and internationally. And then you can find, and again, probably the third factor is there are vehicles out there. I chose some. There are other fund families that have them, that have dividend-oriented strategies in all of these categories: large, mid, and small, domestic, international, and emerging markets. That you can find them now, and they didn't used to be there the last few years. And so you can get diversification both domestically and globally, and that going forward, I guess factor number or item number 4 summing up is again, with a relatively weak US dollar and a lot of years of US market outperformance relative to developed and emerging markets, the tide may be shifting. And so what your portfolio should look like over the next decade shouldn't necessarily be what's worked in the past. And so, I'm allocating many more of my assets to the global front, the international emerging markets, because I think that's going to be a better place to be going forward. And again, particularly in emerging markets, because, growing populations, more consumers spending more money, you've got aging demographics in the US and faster growing companies. My forecast is not alone in this, but a lot of analysts that you will see from different fund houses, different investment strategists that are saying the same thing. It's not my unique thought pattern here. It's just that if you look at the absolute numbers in terms of growth potential, you need to look at emerging markets. And yes, it has traditionally been volatile, but it's an area that is probably going to be growing much faster than the U.S. will over the coming decades. So those factors, so be diversified by market capitalization, be diversified by global and or by domestic and international, and realize that you can get high yielding investment vehicles for all those categories now. Again, WisdomTree isn't the only fund family that offers them. So yeah, I apologize. There was a lot of information packed into this presentation, but if you have questions later, happy to answer them, and or take a look at the presentation and go through it again. But I think they're just want people to keep an open mind about broadening their diversification.
That's a helpful summary. Thanks.
I have a question for you, Todd. For these equity portfolios, especially one of these emerging market portfolios, are these all qualified dividends? In other words, do you get the 15% tax break here on these guys, on these emerging markets?
Oh, I haven't. Not absolutely positive about that, Andy. I think you should, because, but that may not entirely be the case in terms of now. Of course, we may have tax laws changing again, under a new administration. We don't know yet.
Yeah.
But so I'm not sure that you're going to get this favorable tax treatment, internationally as you do domestically. It may be higher or lower depending on what countries you're investing in. But I think by and large, you're still going to keep most of what you earn. And if you're buying in a, tax exempt portfolio like a 401k or an IRA rollover, you're going to get, it doesn't really matter anyway, because there's
right, yeah. Mm-hmm.
So that has to be where most of my money is. So I don't have to pay attention to that. But in taxable portfolios, it can be, asset location can be important. It's just like why you put, it makes sense if you got a tax deferred account and a taxable account, you put your real estate investment trust and things like that to kick off more taxable income in a tax deferred vehicle. And you could, if you had, for example, equal size portfolios for domestic and international, you might say, well, I might put my international equities in the tax deferred vehicle so I don't have to worry about it, and keep my taxable money where I know what the tax laws are in my domestic equity, for instance. I know I'm just thinking out loud, the way that you might be able to do that. So.
More questions, please.
Gets complicated. I see a question.
Do we have more questions, please?
I see one on the screen. Let's see. Can you, Tom? Can you see that one? Let's see.
Sure. Let me read it to you. This was from Sean. It looks like, I would like to diversify into international dividend paying stocks.
Yeah.
Can you show the slide again that shows how your portfolio was structured for domestic, international, and emerging?
Okay, which slide is that. That would be,
You remember which page it was? Just tell me the page number and I'll get to it, Todd.
you mean in terms of percentages? Let's see.
Probably, I think that's what he's looking for. There was a slide that showed the percentages.
Yeah.
Wasn't too far back, I don't think.
We had some that looked at market capitalization and some that looked at investment style. I'm flipping through this to remind myself of what page he's probably referencing. I think that would have been one of the results, one of the reports that we had from the Morningstar Premium.
Yeah, I mean, the issue is that most people have got a lot of domestic dividend paying stocks. So it's a good idea to move to international stocks, particularly because of the valuation. But, you know, it's be interesting to see how much of your portfolio you're thinking about you should hold in international and emerging markets.
Well, again, this particular portfolio, I know that we had basically, it was positioned, and I positioned it aggressively, deliberately in terms of allocation to international, but it's still about 2/3 US equities and 1/3 international. So it, 2/3, 1/3, and I think that generally it's considered an aggressive allocation if you have 40% of your account in international equities. But again, because you can get the high, you don't have to compromise on dividend yields there. You can get those high yields in developed and emerging markets investments, and that you can get nice exposure here. For instance, this portfolio is invested about 18% in Europe, about 18% in Asia, and so you're pretty broadly diversified there. And that was also deliberate because although they have traditionally been more volatile emerging markets, there's more growth potential there. I'm not an earnings bull on Europe, and one of the reasons I was invested when I was in the business and in my own investments for years more lightly in internationals, because Europe wasn't growing very fast. They're not as entrepreneurial. They haven't seen the kind of capital appreciation, but because you're getting more higher quality companies in Europe and Asia, and you can get the dividend yields there, I think it makes sense to have some exposure there. And coupled with that, again, that positive currency translation from the cheap dollar. Well, the dollar isn't cheap, but it's cheaper than it was. Okay, so you're getting those effects. So I do think it makes sense to have, as much exposure in, particularly in emerging markets, as you're comfortable having, and recognize, this should really be, when I tell everybody this, I think, any equity money you have should be 5-year money anyway, because you don't know what the market's going to do over the short term. And even emphasizing dividend yields, you don't know what the markets are going to be doing, but that it does make sense to think of that as long-term money, and maybe have if you've got more than one investment portfolio, one of them might be longer term, one of them might be shorter term, where you might need to access the funds sooner rather than later. Maybe you'll have that more domestically oriented, and but you'll have the longer term portfolio invested in areas like emerging markets. It may take longer to play out, but you may have really nice appreciation in addition to nice dividend yields over the next 10 years, for instance. So that might be one way of looking at it. Does that make sense?
Yeah, I think the way the dollar is positioned right now, and the fact that the valuation of U.S. domestic stocks, I mean, certainly I think looking at international stocks makes a lot of sense, and international stocks are roughly half the world economy anyway. So I think having an international presence is is a very good idea.
Well, yeah, when you look at in one of those other charts we looked at that showed, well, they are half the world's economy, but they're not half the world's market capitalization.
Right, right.
So richly priced, and you can make the argument, gosh, are domestic equities priced for perfection here, and that get a market pullback. Some of the international and emerging markets may be more resilient in a price pullback because they've got higher growth potential. And you know, with the falling U.S. dollar at your back, you know, you can make that case. So, and so this is, you know, this again modeled out an all equity portfolio that's pretty aggressive, but you're also getting almost a 3% yield to start out with, and more with the compounding effect of the dividend growth strategies. So, and it's really, this is a separate topic, but maybe a good topic for future. You know, it's conventional bonds, you know, aren't paying you anything. So, dividend yields in your portfolio yields from other categories like higher yielding equities and all the categories we talked about today, and recognize that that maybe you shouldn't have as much in bonds. And that's coming around a lot. I've read a lot of articles, I'm sure you've seen them as well, that, you know, people think of, you know, standard pension fund allocation, 60% equities, 40% bonds. Well, you know, I remember telling clients this for years, is that don't expect the bond portion of your portfolio to provide the kind of return it has over the previous decades, because you've had falling interest rates. And you can't really have falling interest rates further when you're close to zero. So the most you can expect from bonds is a current income return, and it's not going to be much relative to history. And so that's why I think it makes sense to look at having more and a higher equity allocation and a more broadly diversified equity allocation. And again, if you can get more dividend stocks there, I think it makes a lot of sense. So,
Thank you.
Todd, do these offshore equity ETFs, income-oriented funds, are they leveraged, and how much are they leveraged? Is there some way you can look at that in Morningstar or to determine?
yeah, well, what I did is select conventional ETFs from the standpoint of these are not closed-end funds that are levered. And I know, for instance, I did a presentation on business development corporations. William did a presentation on closed-end funds that employ.
Yeah.
But these are not those vehicles. These are generally unlevered exchange-traded funds, and so they should be less risky from that standpoint. I could have put together portfolios, you know, these portfolio to include closed-end funds that had some leverage and a lot higher yields than I'm showing you today in this. But I didn't want to do that and just assume that we're doing whatever we could to boost the yield. This overall, I think, is still pretty conservative for an all equity portfolio.
Okay.
So no levered closed-end funds in this model, at least not deliberately, unless there were some that I'm not aware of.
So an ETF in general is not levered at all. Is that what you're saying? Are they?
Most exchange funds are not.
Okay.
Yeah, most conventional exchange traded funds are not. But the closed-end funds, that's a different situation. They employ leverage up to 30%, and different situation. So.
Yeah, William went over that very nicely in his presentation. Yeah, I just was wondering about these other ones. This is very good. More questions, anybody? Don't be bashful.
I'm not even sure how to ask this question, but
I mean, I'd be sure how to answer.
a lot of your perspective here has been looking, or at least considering, total return. You know, and you mentioned this is, you know, as you look to international diversification, think of it as your 5-year plus money. For those of us who are really more interested in an income stream than in 5 or 10 or 20 years having a big pot of money, is there any kind of different perspective you would, provide us with to say, hey, if you need to, have almost an annuity of income coming for the next, 10, 15 years, as opposed to getting the highest total return, is anything implied from what you've done here, your research here? I don't know if I've asked that well, but.
Well, I think I know what you're saying, but that's really what I tried to design this here, and I deliberately kept bonds out of the allocation because I wanted to show, here's what we can do with just equities. And so, and frankly, with the yields on equities anyway, providing, dividend yields on equities are higher than a lot of what bonds are paying anyway. It's not like we would have picked up using conventional corporate and government bonds. It's not as if we would have picked up a lot of yield if we'd had, like, for instance, a 30% allocation of bonds in this example. We would have given up, we would not have picked up much incremental yield, and we wouldn't have any capital appreciation for 30% of the portfolio.
Right. And I totally agree, or think the same way in terms of the timing on bonds is not good. But also, when I look at what this particular scenario, where you've put together something that generates 2.8%, even though it's very conservative, I guess that's 2.8% would be a little tough for me to kind of subsist on.
Well, yeah, but if you get some capital appreciation there, as you're likely to over at least a 3 to 5 year period, then you can take some of your return out of equities. And I think also I should say one other thing about bonds here too is that you can actually and I've seen this happen in the history of the business, is people don't think they can lose money on bonds. They don't think they lose principal, but interest rates rise. You can do that. And even bonds, of course, took a price hit in the spring of this year because just about everything went down during the pandemic sell-off. And, so it's not like, but if you get interest rates rising and they, just because I said earlier, well, the Fed isn't raising rates, that means short-term rates for 2 years. But what if inflation rears its ugly head? And what if we have a higher inflation rate than expected? And inflation is starting to show up in some asset categories too. And you would think that we might get some based on what the Fed's doing, basically saying, we're not caring. In fact, they even said, we don't care about inflation. We just want to boost the economy. I'm not saying that's wrong, but that's what they've said. And in a situation like that, well, what if we get more inflation than expected? What if that boosts bond yield more than expected? Because if we get higher inflation, interest rates generally go up and bond prices go down. And so if we get that situation, we could see some people losing money in bonds and really saying, wow, what do I own money in bonds? Whereas if you own, equities are a better inflation hedge. And if we'd added in other categories, which we didn't today, like real estate investment trusts, REITs, or commodities, you could get more of an inflation hedge there. And actually, in a portfolio like this, it would make a lot of sense to have REIT exposure too, because you can get some pretty high dividend yields in the REIT world. And so, and those are a good inflation hedge. But bonds, you can say that TIPS are Treasury inflation expected securities. You really have to own those right. So there's not, but the main point is there's not really much of an inflation hedge in a bond portfolio, but you can get an inflation hedge in the equity portfolio. So I'm just thinking it's hard to make, it's probably harder than it's ever been to me to make a case for bonds, conventional bonds, in conventional bond structures. I mean, I own preferred stocks and things like that in closed-end fund structures where I can get a decent turn into some leverage to boost the return. That I'm comfortable doing, but conventional bonds, it's really tough to make a case. So that would probably be point number 5 when you ask me to summarize the points, is just you better reassess your bonds pretty carefully. Don't think you can't lose money in them if interest rates rise. So By the way, I see another question here I didn't answer. And someone asked, within a market cap category, are most of the Wisdom Tree funds? No, Wisdom Tree cap weighted. Wisdom Tree doesn't do capitalization weighted funds at all, is my understanding. So, and again, they're not the only ones that don't do that, but I have an anti-capitalization weighted bias. I admit, and that's one of the reasons why I chose Wisdom Tree in this particular example. They specifically stay away from that, and that's conventional wisdom. That people do default to capitalization weighted funds. I've had discussion with some of our AI speakers, about this particular topic, and some people shrug their shoulders, but I think it's significant. And I feel more comfortable in something that's more dividend weighted or more, at least more equally weighted, so I don't get hammered if some of the big 5 or 6 companies corrects in price. I think it's a tougher place to be. So Wisdom Tree stays away from cap weighted. You don't have to worry about that if you select them. And again, don't work for them, don't get any compensation from them, but I do think highly of them.
More questions? Well, we're a little past 3 o'clock, so let's see if there's no more questions.
And I got one quick question.
Yeah, sure. Go ahead.
Sean here.
Yeah.
What about the Canadian market? How does that compare? I was thinking about, as you go internationally, you're taking on more risk.
Mm-hmm.
And obviously Canada is probably lower risk than maybe going to places like China. I wondered how, Canada compared in terms of their valuations with respect to the US.
That's a good question. I haven't looked at Canadian investments specifically recently, and I didn't as part of this portfolio. Certainly, the funds I selected will have some Canadian equity exposure, but traditionally you've had a lot of natural resources based companies in Canadian markets because there's a lot of oil, energy exposure, as well as mining, gold and other precious metals exposure in Canadian market. So it might look a little different from getting some more basic industry and commodity exposure with an emphasis on Canada. So, but no, I think Canada came through the last downturn pretty well, and they definitely have some high quality companies in Canada, but I didn't look at it specifically, and they're not growing as fast as China is, for instance.
Sean, from a point of view of, there are a lot of these Canadian companies are natural resource based or commodity based. And so, if you believe that inflation is going to take off, let's say in the next 3 or 4 years, then they might be good deals, they might, because commodities typically do very, very well in an inflationary environment.
Yeah, that's an excellent point.
Yeah. So
that is a good point, Andy.
Yeah. I don't know. They might do okay.
Thanks.
Any more questions?
We had another question about how many. Well, there's one question here that I see in the chat room about how many ETFs comprises portfolio. I think I selected 18 separate funds in this portfolio. That's a lot of funds, and it's probably technically overly diversified. But I begin because I wanted companies in large, mid, small, domestic, developed, and emerging markets. So that's 9 different categories. And because I selected.
You're cutting in and out, Todd. Maybe you have to get a little closer to the mic.
And growth and first category. So that's 18 funds in those categories, those 9 categories, 2 funds each. So for domestic, developed, international, and emerging markets, international, large, mid, and small cap, I wanted to make sure I covered all of those categories. So.
Any more questions for Todd? If not, what I'll do is I'll stop sharing here and I'll go back to my presentation and do this. Okay, and then Todd, I want to thank you very much for
My pleasure.
your presentation. You know, I really have been looking for guys to speak on this particular market because, you know, frankly, I don't have a lot of experience or knowledge about how to deal with ETFs or mutual funds or anything in this particular area. So this has been really very helpful, I think, because we have a lot of people, I think, in our group who, you know, don't really care to do individual stock investing, but you know, like the idea of, you know, doing something with ETFs, you know, it's a good approach.
Or mutual funds, yeah.
Yeah. Okay. So, what I'll do is, Happy New Year to everybody. And what I'll do is, I'll send out a notice for our next meeting, which will be somewhere in February. And I've left up this, this cartoon here for Dilbert, who's doing the Zoom call kind of joke kind of thing. And my email address is down at the bottom of the screen. And, you know, if you have any questions about this, what I'll do is I'll get John to post this on our website, and probably we'll add the PDF file as well, John, so that that people can actually download that and look at it too, in addition to the video version, because the video version wasn't quite as, I think, doesn't give you all the information you need. So that'll be there available. Usually we get that done within, you know, a few days, maybe by the end of certainly by the end of the week, probably. So it depends on John's schedule. So I'm going to stop recording at this particular point and say to everybody that we will be getting in touch with you again with our next meeting sometime just a couple of weeks before the February date, and let you know about what's going on. Any other comments or questions before we wrap things up here? Okay, so I will stop recording and say goodbye to everybody and Happy New Year.